What's going on, YouTube family and friends? Welcome back to the channel. And what we came to discuss here today, due to the excessive DMs over on Twitter, I'm going to further explain why I believe ACHR may have an offering here pretty soon. And before you rush to the comment section calling me a shield, those that have been around for a while is well aware of this already, but 90% of the stocks that we talk about here on YouTube, I do not buy. Not because I don't believe they're a great buying opportunity, but solely because legal reasons, and of course not having a position in either side of the fence really gives me a unbiased opinion, and that is how I'm able to come with this accuracy. And if you have been keeping up with the channel, you're well aware of my gamma squeeze prediction for ACHR. With that being said, it's one thing that can get in its way, and that's the company itself and its offering. And before this video is even over with, I promise you, you're going to realize the huge potential of ACHR having an offering sooner than later. Now, guys, I just want to refresh your memory a little bit. Remember when GameStop seen that huge pop in price during the resurfacing of Roaring Kitty? Well, shortly after, it dropped faster than it has risen due to what ACHR is getting ready to do. And Roaring Kitty would have also seen this coming if he had known what you guys are about to find out here today. First things first, you want to find a company that has no revenue. Also, you want to find a company that is blowing money fast, backed by less cash on hand than a pizza man, and looking as though that their operating cost is increasing year over year. It is obvious that the company is going to have to make a strategic move here pretty soon. Getting closer towards $500 million in operating costs year over year. Let's say the company is looking to raise enough cash run for 3 years, so $1.5 billion. And with that share float at 287 million and the total share count around 425 million, gives the company roughly around 150 million shares to offer to raise this capital. Now, this is where it gets interesting and obvious that a offering may be on the horizon. If we look at 1106, okay, early last month, the share price was only at, let's say, a flat $3. So even at that point, 150 million shares being sold at $3 doesn't cross their $1.5 billion threshold that they're looking to acquire for the next 3 years of cash runway. And with the company spending closer towards $460 million a year, that doesn't even give them a year of runway. So let's fast forward. Now the share price is right around, let's say, $10 even. At that point, now they have met their threshold and now they are considering a offering. But this is where it becomes profitable for the insiders themselves. And it's more so about the shares they're able to withhold instead of the capital they're trying to raise. So let's fast forward. Let's say the end of the week this Friday, we're sitting at a $20 share price. Well, at that point, all they have to do is sell half of that 150 million shares to cross their threshold. The more shares they're able to withhold, the more profitable it is for them. I know this got you wondering, why would the company initiate an offering and instead just allow the share price to run? And since these decisions are being made by the front office themselves, they actually know news way before it comes out, weeks before. So with that type of knowledge, they're able to use it to their advantage and initiate the offering closer towards the bad news. And what makes ACHR so alarming is the company has the ability to perform an offering with no warning due to the large difference in the share float in comparison to the total share count. And for those that is new to the market, the share float represents the total amount of shares tradable on a given day. So when that number increases, it makes existing shareholders' position value drop. Let me explain. Just to make it easy to understand, let's say Making Easy Money get listed on the NASDAQ and we have a total of 10 shares and you own one of them. Well, you own 10% of the company no matter the value. Now, let's say we have an offering and now we have 20 total shares. Well, your 10% of value just instantly dropped to now 5, and that is a huge effect on any existing shareholders. So even if a company's product is very promising and has a lot of potential, a lot of these major corporations would pass on making early investments due to the obvious phases of dilution, especially when you're bringing a product to market that isn't cheap to manufacture at all. Now, different case scenario, we would have gotten a warning for a offering if the total share float was maxed out with that total share count. Then they would have to call a shareholders meeting for a newly issued shared offering. So if you think about it, the higher the share price gets, the greater the chance of a offering taking place. So with that being said, if you are one of those shareholders that has a very low cost average, let's say you're up over 100%, you may want to consider partial profits due to the fact that, again, that offering is going to come with no warning, and that can actually kill the momentum. But there's times that I have seen offerings be eaten pretty darn quickly due to the huge retail investor interest of said stock. So if you're one of those shareholders that believe that this thing is going to continue to run, that's where that partial profit comes into play. If you ask me, and I'm up over 100% here in ACHR, I would leave about 20% of my position still around, and I would lock in 80%, guys, because again, dilution is in store for a company like this. The early stages, we've seen it happen with EV, and it's going to happen with every single startup industry out there. And if this takes place before January 17th, you can kiss the gamma squeeze hopes goodbye, because depending on the price placement of said offering can really have a devastating effect on the hopes and dreams of that gamma squeeze being achieved. Not only that, we can actually see a dirty move being played, and let's say you're a market maker. You tell the company, initiate that offering, and we will buy that entire offering at $1 higher. Dirty tricks like that, ladies and gentlemen, can be made. It's a lot of moving parts in the market. I just want you guys to stay well aware of that, because not only does it make sense to do a move like this as a company, if you're long on ACHR, yeah, it's going to affect your current position, but the company has no other choice, and it's the smart thing to do. A lot of retail investors look at this as a dirty move to have an offering to raise money, to take advantage, but that what comes with early investments in a lot of the startup companies. So with that being said, ladies and gentlemen, if you do agree with anything I said in this video, and if I have made any sense today on why I feel as though that ACHR may be setting itself up for an offering, can you please leave a like in the comment section below? Also, those that are currently playing our giveaway, just to let you guys know, in order for you to be able to DM me, I have to DM you first. So that is why I tell you to tag me in a post, so I am aware that you are participating, and then I instantly DM you, and then you can DM me the number. So with that being said, do you want to make money on Monday? Well, check this video out.